For joining in. Do you get the sense that markets have priced in all the good news that there could be, whether it's in terms of the inflows into the markets, cheap money, abundant liquidity, the economic recovery, and after this dizzying 75% rally from March lows, are you getting a bit cautious?
Yeah, hi, good morning, everyone. See, now post a sharp rally over the last few months, it may be reasonable to see some consolidation. However, we expect declines or corrections to be short-lived, given that incrementally factories and businesses are accelerating back to pre-COVID levels. From a valuation perspective, the erstwhile polarized market is becoming more broad-based. And despite the strong rally, there is still some disparity between performance of various sectors or companies, and there are still pockets of value. I mean, as the market spends more time in bullish phase, second line stocks or value or distressed companies will get recognized in terms of undervaluation. Now, in mid and small caps specifically, what we have observed is there's a mean reversion of distress valuation is happening deeper down the market cap curve. And we believe out of favor value opportunities exist and will outperform expensive quality stocks going forward. And this is typically the nature of the market. I mean, the second and the third line tends to participate, which have been lagging behind. And we believe a number of companies in the small and micro cap space are still available at about 6 to 10 times their normalized potential operating cash flows, even though their near-term earnings will reflect muted but sequential revival. In short, I mean, market will continue to be broad-based and any correction at best will be short-lived. Hence, trying to time the market is a futile exercise. Now, you are rightly pointing it out. I mean, despite the rally, there is still a lot of skepticism and people are worried about resurgence of COVID cases. The risk the economy could suffer from resurgence of COVID and consequential lockdown cannot be ignored. But the market is a forward-looking discounting mechanism and such resurgence of cases has been forecasted for months. And we believe, given the fact that there will be a significant incremental unlocking phase and the businesses open up, there will be additional stimulus bills getting passed, consumer spending increases, and vaccines are rolled out. I mean, those corrections in the market will be short-lived and it will accelerate to newer highs in times to come.
Dhiraj, so where are those? Let's get down to where are the opportunities? You said there are disparities, right? Stocks are still available in the broader market at 7 times, 10 times earnings, less than that. Talk about some of those opportunities. I mean, if you can talk about specific names, that'll be great. If you can identify pockets where one can look for those names, I mean, that'll be second best. But go on.
So, Prashant, the opportunities is several in the middle and small cap space. I mean, we have seen 3 years the market has been polarized across a few companies. And as the market is spending more time in this bullish phase, we're seeing that recognition of the undervaluation and distress valuation is beginning to happen. And I think there's still long way to go because in the last 3 years they have been battered, especially in the mid and small cap space. So we have invested in, we find opportunities in consumer companies, whether it's food processing, beverages, health and personal care, or durables, a durable sector where demand is steady with sustained growth. Packaged food continues to see strong demand and overall steady outlook driven by rural demand. We also see opportunities in agriculture-related companies that produce farm equipment like tractors, fertilizers, seeds, and crop protection companies. I mean, recent reforms, farm reforms are long-term transformative and is a start of a new era for the Indian farmer. The face of Indian agriculture can change for the better. Specialty chemicals have been liking, and I think there has been some kind of a re-rating, but we still believe what pharma was 20, 25 years back can be a repeat story for specialty chemicals in the next 10, 15 years. So we believe there will be continued business shift from China due to pollution control norms in the earlier phase in the last 5, 7 years, or expected China plus one strategy to have India as an alternative supply source. Huge amount of capex is happening in this space, which is an indicator of growth prospects of specialty chemical spectrum. Besides, specialty chemicals are the building blocks for pharma, personal care, like flavors, fragrances, and agrochemicals that are in the essential category. We also like, as a contrarian, the metals, we have seen some kind of a rally, but we believe for the next 2 quarters, both ferrous and non-ferrous metals will see earnings upgrade cycle to happen, given the fact that they have been driven by a lot of import of industrial commodities from China. Cement is another area which is a proxy to both real estate and infra, and this is a cash flow generating business. We find opportunities in cement space as well. Autos, again, we believe it's more not just the festive season demand, but the personal mobility will drives sustained momentum in the autos. We already saw Maruti increasing their production targets, anticipating that this is not just an inventory fill up during festive season, but the demand can actually sustain beyond festive season as well. So we like the auto space as well.
Okay, that's a fair amount of sectors that you've spoken about where you are constructive. You didn't mention anything on financials, banks, whether it's private, PSU, or even the NBFC pocket. Why is that? What is the concern there?
So, financials have recently rallied on the back of improved collection efficiency. However, we would prefer those that have access to capital and the quality of book is secure. Even as normalcy in business is coming back, of course, the collection efficiency will improve gradually. But at this stage, would prefer secured lending companies like housing finance with no exposure to builder loans, or even microfinance companies, despite being unsecured and are at risk, but their target market is rural lending or agriculture that are in the essential category. So microfinance is also a space which is likable. But overall, the financial services may still have near-term challenges given post-moratorium period has just started since September. The challenges do exist related to asset quality and growth. Fundraising exercise has been resorted to by many NBFCs in the recent past to shore up their capital in this tough environment. Pandemic-induced pain on asset quality is yet to show up in gross NPA because many of them are still underreporting, while the larger conservative banks, private banks, and conservative NBFCs have done front-loading of provisions and guarding against any potential risk in post-moratorium period. So I think we will have a better handle on the credit cost in the December quarter, which is the first quarter post-moratorium period, and whether borrowers make payments or not for a few months during this period, which is post-moratorium. Overall, we are currently very selective in the sector. We are not saying opportunities don't exist, but let's see the borrower behavior during a post-moratorium period.
Again, Dhiraj, there is. The valuation comfort is gone, right, in that space. The point is not the prospects. So the common argument for financials I've heard is that, all these banks grew retail books 5x, 6x over the last 10 years. COVID has been a huge stress test and they've come out with flying colors. Most of them, at least the larger ones, have all said we need to provide an extra, they expect another 100, 150 basis points of loan losses. That's it. That's nothing, right? So, if that is the case, then it's a clean run. That's the argument given, and maybe correct. It fits neatly. But again, there is the point about valuations even in the financial space. If you price in pretty much everything which can go right, what if things start to go a little wrong? Should we expect some pullbacks there as well in the financial space?
Yes, I think, Prashant, your observation is right because they are not completely out of the woods. In private banks, some of them are still quoting at more than 2.5 to 3.5 times book. Some of the large NBFCs perceived to be great quality are still quoting at about 4 to 5 times price to book. So valuations have run ahead of time and the post-moratorium period is just 2 months old. So there will be near-term challenges to see how the NPA and the book quality pans out during the December quarter and beyond. Some of the small businesses are still facing challenges and business losses during the pandemic environment. And there was a Supreme Court judgment earlier that you can't, during the moratorium period, you can't classify these borrowers as NPA. So we still have to see whether the NPA again, gradually increases or it recedes. The collection efficiency figure has been great at about 90 to 95%, as reported by many cases. But we can't see unabated run, as you rightly pointed out. We may see near-term challenges. There could be some pullback. There is still some uncertainty. And then once the December quarter finally throws up a number, the market will be very selective, differentiating those which have better due diligence, better asset quality, lower NPA trends than the rest